Hello, everybody, and welcome to today's A-Team Group webinar. My name is Andrew Delaney. I am President and Chief Content Officer at A-Team, and I'm going to be hosting today's session. Today, we're going to be talking about the future of European equities and trading technologies, 2024 and beyond. Our premise is that the year ahead, 2024, is poised for some transformative changes. The reasons for which we'll be discussing in a short while. And we expect these to influence the future of trading tech and of the equity market. So we're going to be looking at the impact of these changes on liquidity. We'll be looking at some forthcoming regulatory changes, the introduction of the consolidated tape in Europe, and of course, underlying all that, the drivers for change. Welcome to the session. Before we get on with our the program, a couple of housekeeping remarks, and then I'll introduce our esteemed panel. First, real one is that we'll be using Slido to conduct polls, and for you guys in the audience to ask questions. You should see the Slido on the right of your screen, so please feel free to enter questions. We'll be introducing those to our panel where we get a chance and they're appropriate. Feel free to ask away, and we'll get you using the Slido for the poll fairly shortly. Before we do that, though, let's meet our panel. Let me start with Elliot Banks. Elliot, welcome. Please tell us a little bit about yourself.
Hi, Andrew, and good afternoon, everyone. I'm Elliot Banks. I'm Chief Product Officer at BMLL. For those who don't know BMLL, we're a historical data and analytics company. We take historic market data from multiple venues at the most granular level three level, which is every single order, nanosecond by nanosecond. We make that consistent, and then we have a suite of products allowing users to come in and easily query and analyze that data.
Fabulous. Thank you very much. Next to Mark Shardle. Mark, old friend of mine from New York days. Welcome, Mark. Tell us what you're up to now.
Thanks, Andrew. Mark Shardle, CEO of DVP. We provide technology and services to exchanges, index providers, data providers for managing their market data licensing, their data licensing more generally, commercialization. The consolidated tape discussion has become a bit of a hobby for me since I was involved in the early days of Caesar working groups when I ran market data at NYC Euronext, and have stayed pretty involved and close to it ever since.
Thank you very much. A little bit gruff on the maybe you can just fiddle a little bit with your settings and see so we can hear more clearly. All right. Thanks for that. Next up, Matt Cousins at Bestex.
Hi, Andrew, and hi everyone. My name is Matthew Cousins, as you quite rightly have said. I'm here at Bestex Research. My role here is head of equities in EMEA, effectively launching a European element to the business that we already do, which is algorithmic trading into North American markets in the cash equity space and global futures. We're also a financial technology firm alongside a brokerage, and we've been growing very quickly of late. So my background is I've been in the electronic trading world here in Europe for 23 years, near enough. Most of that time has been at various different investment banks, including Credit Suisse, Barclays, and Citigroup.
Very good. Thank you very much. All right. And last but certainly not least, we have Ian McIntyre from our sponsors today, Pico. Ian.
Hi, thank you, Andrew. Yes, my name's Ian McIntyre. I'm the global head of market data for Pico. I've been around the market data industry now for coming on 15 years and across a number of different companies, spanning exchanges and vendors. And Pico, just as a little bit of background for anybody that doesn't know, is a global provider of infrastructure, software and services to the capital markets. And in relevance to today's conversation, has a very large portion of its European operations focused on the equity markets.
Absolutely. Great. Thank you. Thanks all very much. Right, let's get started on the session then, the meat of the session. We're going to kick off with a poll question, which we're going to pose through Slido and ask you, the audience, to vote on. And the question is, what do you see as the #1 priority for European equities market participants through 2024? Is it regulatory change, technology change, finding new sources of liquidity, cost-saving measures, diversification into other asset classes, or is it some other major thing that's keeping you awake at night? So go ahead and use Slido to vote. It's, as I mentioned, it should be to the right of the screen as you're looking at us. And while you are voting, we're going to kick off with our panel discussion. So we'll have a sort of a macro level question to kick things off. I'll throw the first question to Matt. According to AFME, Matt, the European share volumes remained flat 2016 to 2022, while the US saw growth in turnover of 40%. At the same time, European primary market listings were also lagging the US by a factor of 3 times. Not a great performance. What do you see as the leading macro reasons for this flat performance in European equities? And what do we think can be done to reverse the trend in the years ahead? Matt.
Excellent question, and one that takes up a lot of time on, I think, a number of industry forums and bodies and around the various chat rooms in the city generally. It's disappointing, isn't it, to see that we seem to be stagnated in this pattern, and liquidity suffers as a result, which really makes all of our lives a lot harder. I think the answer to the question is complex, but there's also some simplicity to it. In the end, if you actually look at that time frame, 2016 to 2022, turnover, as you say, has been documented as being roughly 40% up versus flat in Europe. But if you actually look at the various exchanges, the S&P is up like 90+% in that time frame. The Dow Jones is up 70%. When you compare that to FTSE, I think it's up 6% from the end of 2016 to now. Eurostock's up about 26%, and Stock 600 is up 22%. So significantly underperforming just in terms of actual growth. And that tells a story in of itself. We just don't have the tech giants here. We don't have the growth story here, and we don't have the mega stocks that the US has. And that isn't going to get fixed anytime soon. That's a reality. In fact, and you mentioned as well that the primary listings element, what we're seeing is a really worrying trend now of big name companies choosing to list in the States or elsewhere geographically rather than the UK or in Europe. The highest profile of those most recently was obviously Arm Holdings, which I think in September was 5 times oversubscribed and chose to list in the US. And what we have to remember is those primary listings really are a function of the secondary market. If the secondary market is unappetizing, then corporates and companies generally are just not going to be looking to list in countries where you see such a pattern, one of low growth and two of very limited liquidity and turnover, because it affects their potential performance post IPO. And I think the danger here is that we get into this pattern and we stay there. I think the FTSE 100 as an index for a long time has been seen as a bit of a dividend play rather than a growth play. We just don't seem to foster a growth environment across Europe right now. Now, that's the macro side, and that's complex. Yes, we've had Brexit. Yes, we've had there are obviously issues in Ukraine and Russia. Now we have the Middle East. There are a lot of reasons why there's a lot of negative headlines around Europe in general. From our perspective as market practitioners, you kind of have to step away from that and say, well, I can't necessarily affect that, but what else can we do to play around the margins and actually improve liquidity regardless of that macro background? Because I don't think any of us here, all of us involved in financial technology companies or similar in some way, shape, or form, or tech firms, I don't see the next Amazon or Google or Apple or Tesla coming out of Europe anytime soon. So the reality is that we want to boost turnover and we want to improve liquidity. And there are ways we can do that. There are, irrespective of the macro environment. And the simplest answer to me in that framework is firstly, we have to find a way to reduce the cost and the barriers of trading in our markets, period. Now, what I think about as being a healthy secondary market is a market that encourages multiple participants with multiple different strategies with and brings a diversity of flows together. And encourages that turnover event to happen. And then we start to boost liquidity. Liquidity begets liquidity, as is often said. The reality is, when we've been introducing financial transaction taxes across the region, Spain in 2021, I think France and Italy 2012 and 13 respectively. Obviously, we have stamp duty in the UK. And then we bring in a huge regulatory oversight framework such as MiFID II that carries a massive regulatory burden and resource consuming cost. You start to see firms stepping away and strategy stepping away. Multiple proprietary trading firms have stepped away from Europe. We don't engage with retail activity because it's seen as very hard for retail to trade. We have a very high cost of clearing relative to other costs and certainly relative to the US. All of these costs are punitive and make it harder and harder for participants to find alpha in whatever way they need to. And that, I think, is the crux of the problem, irrespective of the macro environment and irrespective of that growth story. That is the problem that prevents us seeing more participants enter this space and allowing us to grow that turnover.
Very good, great perspective. Thank you, Matt. Over to you, Elliot. What are your thoughts on this?
Yeah, I think before we sort of dive into the question a bit, I think it's always worth giving a little bit of context on the size and scale of the US market compared to Europe, because we always sort of have this sort of apples for apples comparison, and actually, the US is just a different beast to Europe. US, notional traded, typically at the moment 400 to 500 billion. Europe's about 60. So it is just a completely different scale that you're talking about here. So often comparing, growth and everything else is a different story because it's just a different scale. The example I like to use is IEX, which is a few percent of the US market, has a similar turnover to the London Stock Exchange. That's the sort of scale that you're looking at there in terms of it. And it's always worth bearing that in mind when you're talking about some of this stuff. Just you are dealing with a market that's at just such a vastly different scale. I think Matt's hit on some of the points really well. In some ways the listing story is as big a story as the turnover story, and in some ways the ARM one is a big story, but actually some of the firms moving over and delisting off Europe and London and others and moving over to the US is perhaps a bigger story there as well. I think it was Ferguson was one of the recent ones a few years ago, and actually their trading volume went up about 3 times since they moved over to the US. And you can see that, very clearly when that New York listing kicks in, just the volume and the turnover that you're seeing there. And that's a story that's, we've really seen over a period of time. And it's something that has to be, well understood. And as, Matt's alluded to some of the different challenges that are there. I think it's also worth mentioning, though, a lot of this is really dominated by the mega caps. Tesla alone has grown its daily average traded volume by $10 billion. Now, if you remember, Europe as a whole is 60 billion. And actually, if you take out those mega caps, the story is still big, but you take out the FANGs, you take out Tesla, you take out Nvidia, which over the last few years, a combination of COVID and a real AI push, certainly on Nvidia in the last couple of years, and before that, Bitcoin, you've actually got a story which is still big, but it's not nearly as big. So, it's always worth, in this context of, comparing Europe and US, to remember that big structural difference of, the size and scale and how much those mega caps dominate, some of the, the headline numbers if you look at the US market as a whole.
Very good. Thank you. Thanks very much for the context there. Okay, so let's have a look at the poll results. Just to remind everyone, the number one priority for European equities market participants through 2024. Number one for our audience, gents, is technology change, which may not be surprising given we're a sort of a tech publication, and that's the people who read us tend to be very much involved in the technology side of things. Swiftly followed by a new source of liquidity, regulatory change, and cost savings. Any big surprises for the panel on this one?
Not from my perspective. I think that actually it's quite good to see. And of course, and you've pointed this already, there will be variance here depending on the type of participant you're asking this question to. What I think is most pleasing is that regulatory change is not at the top of the tree now, and that was the case for a number of years.
Great.
I think I think that the top two are actually linked. But it is actually refreshing that I feel that we've come out of that MiFID II world and post-Brexit to some extent, and we're entering back into a period of time where people are a bit more focused on innovation. Like, what's the next thing that we can do, rather than worrying about compliance with regulation or wider events of how many people I've got to place in a Paris office or those kind of compliant issues. I think we are finally entering at least a period of renewed innovation, and I hope that this poll is somewhat reflecting that.
Very good. Anyone else? Any observations on this? No. Okay. Well, let's move on then with the program. Matt, we're going to stick with regulation for the next question, I'm afraid. But then we'll move on to really exciting stuff. I'll throw this question to Elliot. Against the backdrop of the sort of flat performance we've just heard about, we have, as both of you guys pointed out, we've had a decade or so of regulatory change in Europe. There is more planned. What's coming in terms of regulatory changes in the next year, and what do we think that the impact will be on markets and customer firms and suppliers? Elliot.
Yeah, so we've had a lot of, there's been a lot of regulatory change over the last 10 years. You've already sort of talked about everything since MiFID launching. There's been, Swiss loss of equivalence, Brexit, Swiss then getting equivalence with the UK, but not with Europe, creating this, sort of Swiss UK trading world and this, European trading world. And since then, we've started to see some of that regulatory divergence between what the FCA are doing, things like the removal of double volume caps, versus the sort of the approach by ESMA on the European side. And certainly one of the things that we're focusing and looking on as focusing on the data side and what information there is, some of the changes to some of the reporting that's coming on, some of the information about understanding where has liquidity gone, where is trading volume actually going. It's something that in Europe is difficult to do. It's not easy to really drill through and understand what liquidity is addressable, what liquidity is not addressable, understanding how to actually interact with that. And it's really important, right? You think, at the start of MiFID, a lot of that led to the rise of systematic internalizers. You certainly saw this huge explosion in volume on those sort of platforms. At some points, it was 20% or more of volume that was trading through SIs. It was huge. It's dropped off a little bit since then, but with some of the increased reporting, that will hopefully help users be able to still get a grips with what's going on in terms of where liquidity is, how to understand that, and how to ultimately use that for something that will be of value from an execution perspective.
Very good, thank you. Mark, what are you looking at in terms of new reg coming in and impact?
Well, I think just for a moment, I'll point that Elliot's point on liquidity. The ability to manage and view liquidity, I think, is more to do with the decline in participation than the structural differences between the US and Europe, quite frankly. I believe that MiFID was really half-baked in terms of its construct, and has destroyed our ability to manage liquidity risk, which naturally causes market participants to have to become more conservative and pull away from market. Their margin of error is just too great in terms of estimating and triangulating where accessible liquidity lies. And I think that's what brings us back to finishing the job we started. To sustain competition properly, there needs to be a well-functioning transparency regime, and we just don't have one. The APA regime has been an absolute failure in terms of its ability to govern accurate and consistent views of the market as a whole, and ensuring that we can participate with our eyes open and operate in a fair and level playing field. We just don't have that ability today. And so I think that leads us back to, how do we get the job done? How do we see this through? looking at the final throes of the consolidated tape, method 3, I'll call it, it doesn't appear that we're going to have an optimal outcome, but I'm hoping that we have the best given the circumstances. And what I mean by that is just the policymaking procedures and process, I think, has been overwhelmed by the complexity of our market structure. And you can see how policymakers behave in terms of conducting consultation after consultation for the better part of a decade, maybe more, asking market participants about their opinions, desires, and needs, and hearing the things that they shouldn't be really concerned with. They should be concerned with ensuring that the markets are safe and efficient for investors and attractive for issuers, period. But instead, they've turned their sights on everything that, represents a cost barrier, because that's a very popular soundbite. It helps industry participants drive commercial agendas, and it's really confused and disoriented them. So I'm hoping that we see now in the year ahead a bit more grounded approach to policymaking. I'm not an expert in terms of the full slate, but my friends tell me not to expect much from the Belgian presidency, and especially since halfway through the year, there'll be a parliamentary election. So that's going to probably cause everyone to go back to much broader issues like how does the EU remain competitive? What are the real issues and ramifications of Brexit? And probably take our eyes off the ball when it comes to microstructure and market structure issues that are really important, but just fundamentally don't connect with the sound bites that drive policymaking today.
Just very quickly, just very quickly to add to that as well. The guys have done a great job of answering that question. I think one other point that's coming up that is going to concern the buy side and could have some impact from a liquidity element is just the conversation around rebundling. Because we all kind of felt that had moved on, and there is now a very real debate about unwinding some elements of the unbundling legislation that came in under MiFID II. That is a live conversation, and yeah, it's definitely being looked at. I think it'd be disappointing personally to see that completely unwound, and I don't think it will be completely unwound, but there's definitely elements of that are being discussed, and that could have some implications on certain names.
For sure. I mean, that would take some time, I would imagine, though, Matt, right?
It would, and more to the point, I think when you speak to the buy side, so much money has been invested in the systems and the models that now allow major asset management firms to unbundle their execution commissions from their research fees, and to suddenly unwind that is problematic for one, and also incurs an additional new cost. That said, the industry is under massive cost pressures. And if there are ways that certain houses can effectively pass on certain costs to their clients rather than consume themselves, if the benefit outweighs the cost, then they will look to proceed with that. So I don't think it's an insignificant point.
Very good, thank you. Okay, let's move on to liquidity. As far as market structure is concerned, one of the most visible changes in the European marketplace over the last several years has been fragmentation of liquidity. How does the panel see this set to evolve looking ahead to 2024, and how is that contributing to the expanding range of data sources practitioners need to ingest in order to maintain a holistic view of the market? Ian, why don't you take a first go at that one?
Yep, sure. Thanks, Andrew. Yeah, I think it's probably obvious to most people listening. Liquidity in Europe is fragmented and has been getting worse and more fragmented over time as regulation has evolved. And I think for any customer, it's just incredibly challenging to understand the sources of liquidity. And like Elliot alluded to earlier, understanding how to access them, let alone understanding how to interpret some of the kind of lower level details about some of the different types of information. And all of this complexity forms a key part of the debate around the consolidated tape that has already been mentioned. I know we're going to get into more detail in the following questions. I think the most visible changes around liquidity, to me, tend to circle around the kind of primary exchanges and their competition in the lit market, as well as a big increase in the growth of off-exchange trading that we've seen in recent years. And to answer the question, how we see things maybe evolving in the year ahead, I I think it will continue to evolve. The years past have shown nothing but that, so I don't see any reason for that to stop. And clearly there'll be shifts in concentration that are perhaps even hard to predict. We've seen some trends around, just more of the same things happening. We've been involved in some recent projects about some new systematic internalizers getting set up, for example, and which has obviously been quite popular in the last number of years. And just in general, I think the environment around exchanges has seen a lot of technological change, and it's interesting to see the poll results there. And obviously with Pico, that is a large part of our day job, just kind of keeping up with the existing environment and how it's evolving. Some of the popular stories in Europe have been around the big data center moves, and Euronext is obviously an example moving to Italy. But there's hundreds or thousands of other changes that go on a day-to-day basis that keep vendors like us busy, and just to keep the status quo moving. So there's a huge technology investment required on an ongoing basis, and I think 2024 is going to see more of the same. So thanks for asking me that question, Andrew.
Sure. Okay, thank you. Matt, let's turn that one over to you. Do we see this continuing?
Good question. I mean, look, there's reams of data out here, and Elliot will be well placed to talk about that data in detail. But when you actually look at what's happening in European markets today, I think the last 6 months, according to data from SIBO and Bloomberg that was recently published by another broker, SI liquidity of the continuous of the lit market activities around about 25% consistently for the last 6 months. That is significant. Right? At the same time, MTF volumes have dwindled, and likewise at the same time, you've seen a further increase. I say further because it was already a significant increase of closing auction liquidity or volume as a percentage of the day's volume. So we've seen some changes. Now, some of this is because we're in a low volume, low volatility environment, right? Spreads are fairly normal. But I think for me, that one trend that I'm keeping a very careful eye on is that bilateral interaction between certain SI participants and the buy side directly. What we have seen most recently, and I think it's been a 2023, end of 2022, 2023 phenomena, has been that bilateral engagement where more and more liquidity provision type models and non-bank SIs are looking to engage directly with the buy side and offer liquidity directly to the buy side. And that has been a marked change. Now, on the face of it, there's nothing necessarily wrong with that, but there are some concerns. And I think that the two concerns I would point to are in the main, at least. Firstly, if you get into a modus operandi where you as a market kind of get used to that, I worry that if the environment changes quickly and that liquidity has the ability to quickly step away, then you've kind of created a problem for yourself that you need to very, very quickly solve for. And the second concern, and this isn't necessarily shared by everybody, and I think this is just a question, is around the level of information that is being given up to certain participants. There are certain models and strategies that are trading high double-digit percentages of European market volume that are now interacting on a bilateral level and starting to garner significant information from that over a larger period. It's not about just the individual trades or fills, but there is a lot of information that can be used in that. And I just think that we have to be a bit careful about that. So do I see it massively changing? Not until we see a change in volatility or volumes or anything like that. I think we'll probably continue to drift in a very similar profile to the one we're in now. But I do think that particular trend is a concern. The only other thing I'll point to here is that what a lot of people don't necessarily cover is the amount of liquidity that takes place in certain SIs that never really shows up as a trade. And that is often the case with certain internalization models where they bring together two forms of principal liquidity, whether that's a derivative hedge or a central book order or any other kind of principal liquidity against other principal liquidity, and they do not have to print a trade as part of that. That is liquidity that's going through, but is never really shown to the market. And as a result, I worry a little bit about whether or not the regulator has a really clear picture about what is trading and where.
I agree, and I'll just add to that, Andrew. I think Matt's points are absolutely spot on, and I worry myself about Well, let's just look at the comparison again to the US, right? They have a limit order protection rule. In Europe here, I think we just lack any sort of incentive to participate in the displayed market. And without those incentives, I think we're going to continue to see these trends exacerbate. And then I worry about the quality of the prices formed on those displayed markets and how well they actually represent the supply of demand for buy and sell interest in the market, or whether they represent some theoretical screen price, as we'd say in the dealer market, versus the true liquidity of the market itself. And when that balance tips, we're on a slippery slope. And so I think our conduct rules and policy rules in Europe are far too weak and ineffective and blunt instruments. And we're going to need to invent a market structure that creates natural commercial incentives to be out loud, to participate in the price discovery mechanisms. Otherwise, we risk losing them. And I think that should be a real concern around the tape. It hasn't been something that's very much debated. We've been talking about the tape as though it's a cost issue, but not a market structure issue, and one that could potentially provide and align those incentives for participation, because obviously the tape only represents what is displayed and what has occurred and in the market display. We can talk about the EBBO proposals in Europe, but that's only as good as the participation in that market, right? So it's only as valuable as that representative quote.
Yeah, I'd add one thing to that as well. The other thing, the big trend from sort of the last 12 months or so has been the rise, certainly, of some of the secondary markets in terms of price setting versus the primary. So it's the first time we've really seen, historically the primary's been on its own in terms of how often it's setting best price. It's been pretty clear that primary is setting that price a lot of the time. A lot more now, there are other markets, other MTFs, other lit MTFs, where actually they're at EBBO as much, or not, if more sometimes than those primaries. So we've had this world where a lot of volume shifting, off book, and we've talking about a little bit, but also they're actually, there's now multiple lit markets where the shares are actually becoming much more even than it ever has been historically. And remember as well, going back to some of the regulation points earlier, a lot of trading venues are now going to be able to use secondary markets as a reference price, rather than having to use the primary. So you've got this sort of combination of things whereby you've got multiple lit venues, quoting, at similarly competitive prices. You've got a lot of fragmentation in the dark and often SI, and those trading firms can be using other markets as their reference price. So there's a bit of a shift here that, as Matt alluded to, it's a low trading environment. Think back to 2020, everything was on exchange, and these things can change, but it'll be interesting certainly to see how that evolves in the next year.
Very good, thank you. So against that backdrop, Ian, my question really is what's the impact going to be on people who are responsible for running trading operations? What do you think are the capabilities and technologies that participants should be investing in 2024?
Yep, sure. Well, I think over the last number of years, we've certainly gained enough experience of customers' requirements to be able to look ahead, and I think it's really an extension of what we've been living through this past while. We've talked about obviously the proliferation of more places to connect, and that always brings more information and more networking and just more technology spend in general. And I would say, if I was going to look at some trends that we see at Pico, the first trend is that I think latency very much matters in European trading today. We see customers caring deeply about what paths our network take, measuring software performance. And there's probably, in my career, never been more demand on that stuff as I see today. And obviously this subject is not new. I mean, we've been talking about low latency for many years, but it's probably got less airtime as it once did in forums like this, but certainly as a trend to start with, I see that as something key for clients to focus on in their investments. Second area, probably obvious for this panel, is increased transparency. As it relates to some of the stuff that we work on, a lot of our focus around transparency is on the technical transparency. So rather than looking at, data content like Elliot would specialize in, for example, Pico provides a lot of services around, network analytics and trade analytics. Finding ways for customers to be more informed about what's happening, as this kind of activity does fragment across venues, being better informed about how and why, where your performance is best and worst. Clearly investing around that is only going to further our customers' success in the markets. And I think the final theme I would highlight is just around something at Pico we call operational excellence, which anybody working in operations is going to know that change is the number one thing that breaks stuff. It doesn't sound very complex, but it's true. And certainly in the European markets, the amount of change in production systems is way higher. And with more connectivity, that just gets worse and worse. So, investing in operations, in staff, in systems, and monitoring tools, I think that's, a trend that will continue to grow, and customers need to be aware of that as they look for the years ahead.
Very good, thank you, Ian. Elliot, what about from your side of the fence, the data side?
Yeah, I mean, look, we already saw at the top that technology is one of the key things that people are very much interested in understanding, and I think this is the longest I've been on a panel this year without, or certainly in the last 6 months, without someone mentioning ChatGPT. So I'll mention that now. But I think look, in general, there's been a real, I don't know if awakening is the right word, because a lot of sophisticated firms have used a lot of that technology for a long time, but certainly much more of an understanding in some of the capabilities of more advanced technologies and tooling that comes alongside it. I think certainly we're seeing a lot more interest in that, but importantly, for any sort of advanced machine learning technique or any other tools that are being used, it all comes down ultimately to the data, and that's something that I think is continuing to be a real source of drive. Certainly a lot of people I speak to regularly, it's about a deeper and better understanding than historically, when it was all very people would superficially understanding, and it might be anecdotal. Now there's much more of a data driven approach across the industry, not just from the sort of the more quantitative end of the market, that actually people are trying to really use data to help drive and back up the decisions. And we've already heard there's a whole bunch of different things that are going on with fragmentation, with regulation. Understanding what's going on there, being able to dive into the details and actually make a really formed decision, and understanding it is going to be critical. And the only way you're going to be able to do that, whether it's for a trading strategy, whether it's for more of a market structure question, whether you're a regulator trying to answer some of these questions, is having good high quality data going back long enough that you can actually start to make some of those decisions. So I certainly think that will continue to grow. From more of a technology side, it's a continuing theme that storage is becoming easier, computers is easier to access at scale, and actually the commoditization of more advanced techniques continues. 10 years ago, you'd have to write up your own code to do basic statistical techniques. Now that's all off the shelf, and actually there's a lot more therefore demand to understand the data, because actually the analytics piece of it is much simpler to run.
Very good. Okay, thank you very much for that. Let's change gear a little bit. We'll talk about something that's been alluded to, or has at least come up a couple of times already today. But let's deep dive into it. I'm going to throw this one first to Mark and then open up to the rest of the panel. Prospects for a European consolidated tape have certainly gathered pace in 2023. Where are we at with the process for the creation of a consolidated tape, and when realistically can we expect something to be brought to market? I know, Mark, you keep an eye on this. What's your take?
Well, I guess we've seen a successful compromise, and that's a big step forward because we've never been able to compromise on this topic before. It always seems like every side of this debate has just stuck their ground and not been willing to go along with what I would call incremental change, right? And that is accepting something better than we have today, with a view towards continuing to evolve the process. I think there's a general lack of trust in the policymaking process that we will ever get around to improving on what we agree and put forward. And so that kind of exacerbates the issue. So we have seen a successful compromise thus far. We haven't seen that consummated yet. I understand that's being heavily addressed and worked on at the moment. We're expecting something to be approved under the Spanish presidency, so that's before year end. And then I think from there, we'd expect a process of probably 2 to 3 years before we see anything that looks like a tape, when you have to go through all of the legal process, the tendering process, which is a big reason why I supported in Europe competing consolidator framework and thought that that might be the lower risk method of getting something off the ground sooner. Because let's face it, anything can happen between now and 2027. Parliamentary elections kind of seemed like the closest thing. War could be certainly something that changes our priorities and takes them away from things like this. And so I think there's just execution risk on our path. And so my estimation is it's 2027 before we see anything like a tape, given what's in front of us.
Very good, thank you. Matt, what's your take on that?
Yeah, I mean, a lot of the points that Mark's made are obviously hugely valid. I think, from my understanding, it might be a little earlier. I think, 2027, it's quite possible, given how things change, involve continued discussion, the pace of implementation, etc. I've talked to a few sources that suggest that after the tender process, you might find a version of the tape implemented as early as 2025, but somewhere 25 to 27 is probably realistic and not before. That's the important part. I think that the big thing here is that there has been some compromise, and there has been an element of discussion around what the first iteration of suggestion came from the Commission looked like, especially around the revenue share component. That's pleasing. So I think the MTFs will celebrate the fact that they're now included in the potential revenue distribution for a tape. And what we expect at this point is a pre-trade tape in equities of sorts, but that will only be level 1 data, and it will be aggregated data. So you won't see the venue necessarily, but you'll see the price and size at the level 1, or the level 1 component of that. So you'll have some element of a pre-trade consolidated tape. Now, obviously, that doesn't tell the whole story, far from it, nor necessarily does it need to, because I think Mark made the point earlier, like we don't have the same version of best execution here in Europe than we do in the States, right? So the idea of having an absolute complete view of what best bid and offer looks like for the purposes of best execution is not necessarily as important to us. However, the big issue here is, like, what is the use case? Like, what is the tape going to solve, and who are we really building this for? Because in reality, anybody who's running today any kind of smarter router that's worth its salt will continue to take direct feeds from all the venues they're trading against and won't necessarily care too much about the tape as a pre-trade data source. I'm sure they'll use it as a reference, but it won't be what they actually use to build their own internal best bid or offer components. So on that side of things, I don't think it changes things dramatically. I can see a reduction of cost for some people. Like, I think a lot of users probably and I was chatting to someone earlier this week about this, where an awful lot of people might have a terminal of sorts like a Bloomberg, and they need data. So ultimately they have to subscribe to multiple venues. Now you might find a scenario where, just having the consolidated tape is enough, right? So you'll see a pretty good idea of what real-time pricing looks like, but you don't need all the levels and you don't need all the venues. So there will be some cost reductions potentially there for certain users. And I think that's important as a function of what we were talking about earlier in reducing cost. But I do worry a little bit that, and this has always been the case, that what are we actually trying to solve for, and who are we solving it for? Is this a trusted source now, a golden source? Is this to help confidence in the market? Is this for to allow the retail a better picture of what's going on? Because I'm not sure yet that that's evident that it's going to do that, I think it gives a clearer picture, and perhaps it will be easier for certain participants to trust that. That said, I think there's enough information around that today that I'm not sure that's going to necessarily change the game. But I think there are some things that are pleasing, and I suspect that over multiple years we're going to see iteration after iteration of this, and it will continue to evolve. And at some point, I think this will become a much more mature looking concept than it will be in its first pass. So yeah, it's a tough one to sort of really get my head around. I think, and maybe Elliot can touch on this as well. I think that the one of the bigger problems here is not necessarily the tape in of itself, but the data that goes into that tape and the standardization process that needs to be undertaken in order to make sure that the information that's garnered from that tape is really accurate. And I think there are efforts around enforcing the MMT protocols from a post-trade perspective to be utilized in a more stringent way. And that should help. But again, it really comes down to how that standardization process is delivered that I think is going to be most significant.
I think you're right on, Matt, with those comments. I mean, we're not building a product, and I think policymakers seem to be confused as though we are building a product for use cases. These are not about use cases. This is about a job not finished. MiFID is incomplete. The transparency element of supporting competition in our market was never there and not well thought out. And we've seen the impact of that and now have to finish that job. This is not about building a commercial product. We have those. Elliot will tell you that historically, this tape exists and many others provide it in real time. We have consolidated tapes today. The consolidated tape initiative has little to do with consolidation of data. It's more to your point about getting access to the underlying sources and ensuring that they're accurate and reliable. And without that accurate, reliable benchmark, investors have no ability to hold their brokers accountable for performance. That degrades their confidence in markets and participation. Institutions have an inability to manage liquidity risk. Maybe we don't hit that out of the gates, but I think we creep up on it over time through iteration, to your point.
Very good, thank you. Interestingly, I'm starting to look at some questions coming in from the audience. The top question is there actual demand for a consolidated tape given the existence, as you mentioned, Mark, of commercial alternatives? So, but it's not a product, is it? It's something else. We're asking the wrong questions, and we have been for a decade. Demand is not what's driving this. Policymakers should be driving this themselves as an investment into our market structure, as an investment into ensuring that markets are safe and attractive for investors and issuers. Full stop. The rest of us will continue to complain, but we'll all go back to our proprietary sources because that's the performance we need to actually interact with liquidity. So this is by far a reference product that solves for the broader issues of ensuring that everyone has the same answer when you asked what traded in L'Oreal today. If we can't have the same answer, we have a fundamental problem that I think persists and continues to undermine our ability to grow this market.
I think, just to add to that very, very quickly, I think actually I slightly disagree, Mark. I think there is demand. I think the issue is that the demand is not going to be satiated because the product that's going to be delivered isn't actually going to satisfy where that demand is coming from. And that's my concern, right? Because you end up with a half-baked solution that really hasn't solved for any of the problems that we talk about. Maybe market data costs, maybe some, but not in entirety. And so I think there is definitely demand from the buy side. I know that in conversation. I'm just not convinced that they're going to get the product delivered that they are either expecting or really want to see.
And it can also increase the costs, in my opinion, because the likelihood of accessing that plus everything else that there isn't receipt of today is probably the most likely outcome, in my opinion.
So
for most users.
Very good. Okay, let's continue. I've got a couple more questions around exchanges from the audience, which I always like to throw out to panels. A couple, one asked about what roles exchanges can play in improving volumes and liquidity from their end. And then does the panel expect to see further consolidation of exchanges and vendors and M&A activity in that sort of market structure space? Anyone want to take a go at either of those? Matt?
I'll happily start. I mean, I think, yes, the exchanges can do something. We've talked about this already. I think cost is a factor, right? And I'm not trying to suggest that the exchanges don't have to make money. Everyone's got to make money and to stay in business, and to a lot of those exchanges, the vast majority of them are shareholder based, so they have to provide returns. I understand that, but there's a balance to strike. Now, when I think you look back in the US, when the liberation of the US market really kicked in, the New York Stock Exchange had well over 90% of its listings trading on its book, and it was terrified of competition, and now it's, I don't know, 20% of those turnover in those listings, yet its volumes are multiples, absolute multiples of what they were before that point, right? And so, there's sometimes I feel a balance to strike between what percentage of a pie you're getting and actually thinking about, well, we could get a slightly lower percentage of a significantly large pie and we still win. And so I think there are cost implications that could be considered by all venues, and actually all the structures, throughout the trade life cycle, that could definitely help improve liquidity in the markets. And I would certainly argue that cost is a function of that.
You mean cost of transactions, cost
Yes.
of data?
Yes, I mean, I'm talking about cost of data and of transactions, but in particular, if we look at functions like the close, where certain venues ramp up their prices going into the close significantly, I think that's a nefarious way of operating, quite frankly, in a monopolistic environment. Moreover, I think that the idea of competition is really to try and drive that competitive function of cost, and we did see that post MiFID I. We're not seeing it as much now, and I think that's hurting us. So yes, that is exactly what I'm talking about.
I disagree. So I don't think cost drives participation in our market, value does. So if there's value to be had and captured, it'll drive performance, it'll drive growth in the business. I thought, coming from your shop, Matt, you might answer something like exchanges could do a better job at showcasing their listings, at supporting research around those listings, and the ability for people to consume and intelligently participate in the market. And I think many of them are trying with rather other types of investments and diversification. But I guess overall, just asking exchanges or venues in general to lower their prices, I think, is something that the competition does. Now we need to look at how we sustain competition in a healthy way. We haven't finished that business yet, right? We unleashed it, but we don't support it with anything that allows markets to be efficient and participants to continue to participate at a healthy level.
Okay, we're getting kind of close to the end, so let's start to wind down a bit. A couple of questions are sort of more broadly looking outside of equities. What other factors may bring change and investment for market participants in 2024? Will it be developments in the FX and fixed income markets, exchange data center moves, anything else relevant from a market structure standpoint that panelists think may impact the sort of the strategy that on technology that market participants take over the next 12 months? Matt, anything else on your radar?
I mean, there's one thing. I'm not a fixed income specialist, and I'm not going to get into the realms of effects of, whilst I have some exposure to that space, I think that I won't touch that. I think for me, there's one interesting thing, which is a kind of global phenomenon, which is the move to T+1 settlement in the US, which comes in March next year. And I think that has implications in a number of ways. Firstly, it will have an effect for a lot of houses over here. Reading a stat, again, we talk about US versus Europe, but something like 40% of the US stocks are actually owned by international holding companies of various sorts, right? So yeah, that definitely starts to make a change. When you think about the times involved, you think about the difficulty from the settlement perspective of managing FX exposure, and just the whole matching of various different settlements. I think that's going to be challenging for a lot of firms. It also has a liquidity implication, I think, globally, certainly when you start to look at ETFs and how certain ETFs get priced and repriced. So there are considerations around that. I'm actually personally quite bullish around the fact that I feel that one of the costs that is super high here in Europe is the post-trade environment. And I'm kind of optimistic that maybe this could drive some efficiencies in that world that might, over a long period of time, help us, because I think that's the sort of innovation we need forced on us almost to help us make some changes in that post-trade world that hopefully will drive some innovation and ultimately reduce cost. But that's definitely one for me that I think is a big factor.
Very good, thank you. Ian, what's on your radar?
Yes, well, kind of ironic in a way, given some of the problems we're highlighting with the equities markets, but certainly from a technology standpoint, I think equities has obviously blazed the trail that other asset classes in some ways are lagging behind. One of the big trends that we've seen, certainly in US fixed income, around the US Treasuries market, has been, an equities-like technology transition, where latency and co-location, all of the sort of common factors in equities technology, have become a key part of that fixed income ecosystem. And we've started to see similar trends, being discussed by participants in Europe. So, from my perspective, I think just from a technology standpoint, the fixed income markets are, obviously behind equities in many ways, but a lot of the trends that we've seen play out are coming into that sector and following. And yeah, I mean, similar-ish, well, probably for different reasons. There's, lots of investment around FX. It's got quite a different sort of set of challenges around the global nature of trading, but we definitely see a lot of customers investing in that space as well. So yeah, lots of things that customers are focusing on from a technology standpoint. And I think just to sort of close on that, from some of the bigger firms at least, I think a very common story has been, trying to find ways to kind of use technology across different business units. Some big firms succeed at that and others have not. But as a vendor, at least, we're getting more pressure to kind of, have common APIs, have common architectures that span the different asset classes. So that's something that, we'll hopefully see more customers investing in this year as well.
I'd probably add one thing as well, not strictly other asset classes, but one of the big things we haven't spoken about too much is, on the equity side, is there's an enormous amount of regulation change in the US that's been coming through from on their own consolidate discussion, competing consolidators, right through to completely changing how retail trading is gonna interact, and some of that stuff is further down the line than others, but it's worth remembering, especially when we talked at the start about US versus Europe. There's an enormous number of changes going over there in the equities market as well, and that will ultimately, we will see. I'm sure we will see things that will drive and that will change across, over here as well. So it's worth bearing and remembering some of that part in mind. Although it's not, other asset classes, the structure and the regulation of the US market is very different, and there's a lot of big changes that are coming over the horizon.
I think that's a very valid point, Andrew. I think that we sometimes forget how many regulatory trends start in the US and ultimately make their way across the pond to us. And so we should always keep an eye on what those look like. And I think there's definitely a huge focus from the SEC on that retail component. And obviously it's a very different mix of flow compared to what we see. But I think it's something to be certainly keep an eye on.
Very good. Okay. Now, you do realize we have got through the whole panel without mentioning crypto, our digital assets, Elliot. So, along the lines of ChatGPT, I'm curious that it really isn't on too many people's radar. Anyone got any comment on that? No, not on the radar.
I guess I was. Go ahead,
I was just going to say, I think it is on people's radar. I just think it's a little early. Like, I don't think we're at the point where, if you're talking about AI specifically, firstly, like there are an awful lot of use cases that are being looked at and investigated and innovation around the use cases for AI, but it's not being implemented just yet. And so I think we're probably a year or so too early to say that this is a 2024 phenomenon or otherwise. I think there are an awful lot of efforts, as I say, going into how AI as a concept can be deployed, whether that's in an administrative function, back office function, or within trading itself. But we're not yet at that point of implementation. Not really, not a widespread anyway.
But my point actually about crypto and digital assets, that doesn't seem to be very high on people's priorities at the moment either.
It feels like we're about to see a raft of reactionary regulatory action as a result of the FTX blow up. Much the same as we saw a raft of regulation following LIBOR scandals. It's very reactive, gets very complex, and takes a number of years to settle down and then kind of fizzles out in the end. I think we'll see the same effect with digital because too much investment has been made into that market already to walk away from. And so I think it just has to weather the storm of what we'll see in the coming years ahead.
Very good. Okay, look, gents, I'm going to wrap things up because we are out of time and people have other things to run to, like picking children up for school and walking their dogs. Let's give them the opportunity to do that. Before we leave, let me ask our audience to please check out our A-Team webinars and events that you'll find below us. Here's a couple for your consideration that are below the screen in front of you. And as we wind down, let me just thank today's panelists, Elliot, Mark, Matt, and Ian. And finally, great thanks to our sponsors, Pico, without whose support events like today would be possible. So thank you all, gentlemen. Really great session today. And thanks, audience, for joining us. See you next time. Bye-bye, everybody.
Thanks, everyone.
Thanks, Andrew.
Thank you.
Thanks all.
Thanks, Andrew.
Bye-bye.